Hi everyone, Logan Hertz here with Hazeltine LLC. I thought we'd talk a little bit about turning the tables a bit on some of the criticisms of whole life insurance. And I would like to have done this as a funny satirical video. Perhaps I still might, but unfortunately, it seems most people don't actually get the humor or the sarcasm or the satire. They think I'm being serious when I say some of the things that I'm about to say. So I have this introduction to suck the humor out of it, unfortunately. And what I want to talk about is one of the criticisms you'll hear of whole life insurance, which, first of all, let's make a distinction. There's whole life insurance, and then there's the infinite banking concept. Two different things. The infinite banking concept is a strategy for becoming your own banker that uses specially designed whole life insurance policies. Whole life insurance is a phenomenal tool that can be used and designed for a whole lot of different use cases. One of the criticisms of whole life insurance is they'll say whole life insurance is a terrible investment because it gets a terrible return. And when they say return, what they're talking about is just the return on investment in the cash value of a whole life insurance policy. So the cash value is like a savings account. It'll make you maybe 4% over the long run. Chris Kirkpatrick and I recorded a video showing a whole life insurance policy that returned over 6%. The problem is that's only looking at one component of whole life insurance. There are many, many, many benefits that whole life insurance gives you. And what that ignores is what is the whole life insurance policy being used for? Because that return on investment in the cash value is just one of many benefits. And depending on how we're designing the policy and how it's being used, we may or may not be trying to maximize the return on the cash value in the policy. And in fact, I can show you multiple scenarios where we would actually want to reduce the return on investment in the cash value because we're designing the policy for different purposes. So what makes whole life insurance challenging is that the real benefits to whole life insurance are not necessarily visible inside the policy itself. And so critics of whole life insurance and people who don't understand it very well just look at the policy itself. And they are, whether they realize it or not, they are comparing it to an investment vehicle, which is not a fair comparison because whole life insurance is not an investment. So the returns are not as relevant. And of course, so when they're comparing whole life insurance to an investment, it's the wrong comparison. So what they'll say is buy term and invest the difference. So they'll say if you look at life insurance, you should just buy the least expensive form of life insurance, which is term life insurance. Now, parenthetically, I can show you that term life insurance is actually the most expensive form of life insurance by far, but they're just looking at the premium level, which is just one thing to consider. Over the long run, term life insurance is way more expensive than whole life insurance. But we won't get into that here. But they'll say you should buy term and invest the difference, meaning look at what would a whole life insurance policy cost you, okay? And then just buy a cheap term policy and take that difference that would have gone into whole life insurance and put it into investments. Again, there's so many things wrong with that. First of all, nobody actually does this. Nobody actually goes and looks to see what would a whole life insurance policy cost, and that let me buy that same death benefit in term, which will be a lot cheaper, and then take that difference and invest it in a disciplined manner. Nobody does that. What they do is they just buy term because it's cheaper and they forget about everything else and they spend the difference. So they don't even know what a whole life insurance policy costs. And asking what a whole life insurance policy costs, again, shows a fundamental misunderstanding of what whole life insurance is. I can make whole life insurance cost whatever you want it to cost. What it costs, quote unquote, depends on how you design it. And when you say cost, what cost of what? The cost of the death benefit? The cost of the cash value growth, the cost of the long term care protection, the cost of a child term rider. There are so many different ways that you design it. And really, what you're doing is you're just optimizing the premiums going into the policy to get you the maximum benefit that you want. And that benefit is subjective to you. You might want a higher death benefit. You might want more cash value. You might want more cash value early on. You might want more cash value over the long run. There's so many things to consider. It's just like a custom built house. But what I want to do is now turn the table. So when they say whole life insurance is a terrible investment, the problem is they're classifying whole life insurance incorrectly. Whole life insurance is actually its own asset class. This is what makes it so challenging. according to one of the members of, I think, Leap, he says whole life insurance is its own asset class. And this is what's so challenging is because people take whole life insurance and they try and fit it into their pre-existing paradigm where it does not fit. It's not an investment. It's not really a savings account, although it's closer to that. It's not really any one of these things. And so because people can't classify it properly and they can't fit it into their paradigm, they don't know how to evaluate. But if we say whole life insurance is a terrible investment because the cash value growth gets a terrible return, and when they say terrible, it's terrible relative to an investment. So you're not going to get 12% returns in the cash value of a life insurance policy, but you might get 4%, which is competitive with a savings account. So if you're comparing whole life insurance to the correct thing, which is a savings account, 4% looks pretty good, especially when you consider it's tax free, when you consider you have death benefit protection and long-term care protection and creditor protection and all the other benefits, the policy loan feature, etc. Okay. But let's turn that around and look at mutual funds because usually they're comparing it to mutual funds. So they're saying, look at the cash value growth in whole life insurance and compare that to the projected return in mutual funds. Now, already we have a problem because the returns in mutual funds are total fantasy. Nobody knows what these mutual funds or the S&P 500 is going to return over the next 30, 40, 50 years. Nobody knows. But they have this religious belief, this religious superstition that the market or these funds are going to go up at 12% per year, 8%, whatever number you want to use, it doesn't matter. The point is, you can never prove that that's actually going to happen. You might believe it's going to happen, but the best that you can say is it is likely that it will happen based on our analysis. Okay, so now we're in the realm of gambling, right? We're gambling. Maybe it is likely that the S&P 500 or these mutual funds will go up at 8, 10, 12% per year. Maybe that is likely, but it's not guaranteed. On the other hand, with whole life insurance, that return is guaranteed. So already we have a problem. Okay, so what you're saying is give up a guaranteed rate of return for a hypothetical rate of return that might be higher or it might be lower. It might be negative. In fact, we know it's probably going to be negative some years. So in some years, whole life insurance will outperform the market when the market is down because whole life insurance goes up every year, contractually guaranteed. So let's look at mutual funds. And if we were doing the same thing to mutual funds that they're doing to whole life insurance, here's what we would do. We would say mutual funds, retirement accounts, these investment vehicles are terrible life insurance because they don't come with a death benefit. Mutual funds are terrible life insurance because they have no death benefit. If you have $100,000 in cash value in your whole life insurance policy and you die, then probably $1 million death benefit pays out. Whereas if you have $100,000 in mutual funds and you die, that $100,000 doesn't magically turn into $1 million. So on the whole life insurance side, we have a $900,000 tax-free gain that we got because you happen to die, which is possible. Whereas on the mutual fund side, you just have that 100,000. That's it. There's no leverage. There's no leverage death benefit. So mutual funds are a terrible, terrible form of life insurance because they don't come with a death. So if something happens to you, they don't magically increase in value. Okay. Mutual funds also don't have long-term care protection. Mutual funds, the index funds, retirement accounts, you can talk about all of them. There's some differences between the two, obviously, but we can lump them all in the same investment category, some form of market-based investment. Typically, it's in a retirement account or maybe it's in a brokerage account, and it's typically mutual funds or index funds, but they all work relatively the same way. There are some differences, of course, but they don't come with long-term care protection. So if you have $100,000 in mutual funds and you have some form of long-term care need, now maybe you need to use some of that money to pay for your long-term care need, which when you're in retirement, this is a huge deal. The odds are 70% that if you are married and you reach the age of 65, that you or your spouse will have some form of long-term care need in retirement. And that can get pretty expensive. If you have to sell some of your market assets to pay for it, which a lot of people do because market assets are the bulk of their retirement assets, unfortunately. What happens is, first of all, now you got to pay taxes on this. So if you're selling them, unless it's in a Roth, you're going to have to pay taxes on those gains. Hopefully you have gains. So you're not going to get the full 100,000. You'll get 100,000 minus whatever taxes are due. Whereas if you have $100,000 in cash value in a life insurance policy, and you have that $1 million death benefit, that death benefit can be used in the event of long term care. So if you have a long term care need, you can start advancing yourself that death benefit to pay for long term care. And again, it's all tax free. It's not a $900,000 gain or anything like that. You don't have to pay taxes because it's an insurance claim. You're filing an insurance claim, you're receiving an insurance benefit because you have a long term care. Depending on the whole life insurance policy, too, typically those are what we call indemnity based, meaning that once you start advancing yourself that death benefit, you can use it however you like. It's not reimbursement based. So you have the long term care need. You can then file a claim with your insurance company and start advancing yourself that death benefit and spend it however you want. Spend it however you want. So mutual funds are terrible relative to life insurance because they have no long term care protection. Okay. Believe it or not, I have had fiduciaries say that you don't need long term care insurance because you have money in the market and that can be used for long term care. There are people who say this. Okay. That's just like saying you don't need homeowners insurance. You got money in the market. So if something happens to your home, you can use those market assets to pay for the damages. You don't need car insurance either. You have mutual funds, money in the market. So if something happens to your car, you can then use that capital to pay for it. If you really take the logic of buy term and invest the difference to its conclusion, then you should not even buy term. You should not buy any form of insurance because you're always going to get a better projected return in the market. Notice I didn't say the actual return will be higher. We don't know what the actual return is. According to a Dalbar report, the actual return that your average investor actually gets in the market is not 12%. It's not 10%. It's not 8%. It's 3%. 3%. Why? Because human psychology impacts our behavior and because life happens. Most people are not able to just let their money sit in the market. Life happens and they have to withdraw some, and that interrupts whatever their plan was, which is why I think that sort of planning, if it can be called that, doesn't really work. Doesn't really work. So mutual funds are also terrible because they don't have an accelerated death benefit rider, meaning if you get diagnosed with a terminal illness, you don't get any money. If you have $100,000 in mutual funds and index funds and a retirement account, and you get diagnosed with a terminal illness, you still only have that same 100,000, no leverage. Whereas if you have $100,000 in cash value in a whole life insurance policy and you get diagnosed with a terminal illness, you can now start advancing yourself that $1 million death benefit. This can be a huge benefit. Chris Kirkpatrick, his father in law, went into the hospital to treat what he thought was an ankle injury. He found out he had a blood clot, was diagnosed with stage 4 pancreatic cancer, and given 90 days to live. So, what did he do? Well, he had a whole life insurance policy. So, he started advancing himself multiple six figures of that death benefit to pay for alternative healthcare treatments that standard health insurance would never have paid for. He had to pay for it out of pocket. Health insurance was not going to cover this. These were alternative treatments. And the standard conventional treatments they were going to offer him were basically, I don't know exactly what it was. I'm assuming it was chemotherapy or something like that. And they said, we can extend your life maybe another 3 months, but your quality of life will be so terrible while you're doing this, it probably wouldn't be worth it. So basically, you're a dead man. Well, thanks to being able to advance himself that death benefit through the accelerated death benefit rider, he paid multiple six figures for alternative healthcare treatments. Now, 2 years later, he's playing golf 4 days a week and playing with his grandchildren because he had that death benefit protection. Other people use it a little differently. There was a woman who had a similar thing where she was diagnosed with a terminal illness. She used the accelerated death benefit rider to simply take her family on a trip around the world. Say, hey, I'm not going to be here much longer. I might as well enjoy the time that I have left. That's the great thing about that rider being indemnity based. It's not reimbursement based. You're not being reimbursed for medical expenses or expenses of any kind. You're just collecting a dollar benefit and you can spend it however you want. Mutual funds don't have that benefit. They don't have that benefit. So we can see again, when they say whole life insurance is a terrible investment, I can turn that around on them and say mutual funds, index funds, retirement accounts are terrible forms of life insurance, terrible long term care protection, terrible savings accounts, terrible financing vehicles. But whole life insurance can be great at all of that. Also, these are not, these retirement accounts and mutual funds are not savings accounts. Okay. They treat them like they're savings accounts, like you're saving for retirement by putting money in a 401k. No, that is not a saving vehicle. A savings account doesn't lose value if the market crashes. If the market goes down by 5%, 10%, 20%, 30%, you lose money in your index fund. You lose money in your mutual funds. You lose money in your retirement account. Whereas in a savings account, you do not lose anything. You're still being paid an interest rate. Worst case scenario, maybe the interest rate you're being paid goes down to zero, but you don't lose any of your principal, which is another reason why mutual funds are terrible relative to whole life insurance, because whole life insurance not only never loses cash value, your cash value is guaranteed to go up every single year. So mutual funds, retirement accounts are terrible savings vehicles because your money is at risk. The root of the word savings is safe. It needs to be somewhere safe where it's not going to go down in value because the market crashed. So mutual funds and retirement accounts are not savings vehicles because they can lose value. Mutual funds and index funds are terrible relative to whole life insurance because there's no guaranteed interest rate you're being paid. I asked a fiduciary once, what rate of return are you guaranteeing your client? And of course, he had to say, I cannot guarantee my client anything. I'd lose my license. Notice how he's not concerned about the loss to his client. He's concerned about himself and losing his license, which just shows you the way that fiduciaries often think. So, mutual funds are terrible. Index funds, retirement accounts are terrible relative to whole life insurance because there's no guarantee they'll go up in value every year. In fact, they can lose value. They could maybe stay flat, have a 0% year, or go down 10, 20, 30%. They can go down in value. Whereas in whole life insurance, we have a guaranteed interest rate we're being paid. So our cash value is guaranteed to go up at a certain rate no matter what's happening in the market. Mutual funds don't come with that guarantee. Mutual funds are also terrible relative to whole life insurance because they're taxable. All the gains are taxable. Now, yes, I know if you put money in a Roth, they're not taxable. So we can maybe exclude the Roth from this conversation. But if you have money in your standard brokerage account or in a 401k or what have you, all those gains are taxable. Whereas in whole life insurance, your gains are tax deferred and will never be taxed if you set it up and manage it properly. So again, mutual funds are terrible relative to whole life insurance because they're taxable. All those retirement savings that you're doing, i.e., speculating. When you're putting money into mutual funds and retirement accounts, you're not saving, you're not investing, you're actually speculating. They're not savings because they're all at risk. It's all that money's at risk. So it's not a savings vehicle. Otherwise, your principal would not be at risk. It's not investing because it gives you no cash flow. If you want to know if you have a real investment or not, ask yourself this: how much do my investments pay me? How much do my investments pay me? The answer is usually zero. That's because they're not investments, they're speculating. If I buy rental property, those investments pay me every month. I'm collecting rental income from my tenant. If I start a business, that business pays me every month. I'm collecting income from that business. If I buy an index fund, I'm getting no income. It's just speculating. I'm just speculating on what the S&P 500 might do. So I'm buying an asset, hoping that that asset will go up in value. And I make no money and derive no benefit from it until I sell it and pay taxes on that gain. That is speculating. And it's okay to speculate. You can do that. Just understand the difference. Don't call that saving for retirement. That's not saving for retirement. That's speculating. And it's okay to speculate. It's okay to speculate. But you're taking on a fair amount of risk and you're not collecting any benefits until you sell it. So that is speculating. Mutual funds are terrible forms of life insurance, terrible relative to whole life insurance because there's no guaranteed policy loan feature. If you have that $100,000 in mutual funds, index funds, or a retirement account, there is no guarantee that you can borrow against the asset while the asset keeps going up in value with no repayment terms. Now, let's talk about this a little bit deeper because some people will say you can borrow from a 401k. Yes, you can borrow from a 401k, not against a 401k. There are very important differences. First of all, you're limited to maybe $50,000, I believe, is the most you can borrow. In whole life insurance, you can borrow 95s, in some cases 100% of your cash value. There's no limit. You could have millions in cash value and you could borrow against all of it. Secondly, and more importantly, when you borrow from your 401k, that $50,000 you borrow is no longer earning for you. It's not earning for you. Whereas when you borrow against your whole life insurance policy, your entire $100,000 of cash value keeps earning for you because you didn't withdraw anything. You just borrowed against it. And you can go up to 95% loan to value, as I mentioned. In a 401k, I think the max they'll let you do is 50% loan to value, up to a maximum of $50,000. And there are repayment terms. So when you borrow from your 401k, there are repayment terms. And those repayment terms can get very harsh, especially if you change employers. If you change employers, you have to pay that loan back in 90 days, or there are consequences. There are tax consequences too of borrowing from a 401k. If you think about it, I'm not going to go into that too much, but if you think about it, you're actually paying taxes on it because the loan is on a post tax basis, if you will. I'm not going to get too deep into that. Whereas when you borrow against your whole life insurance policy, there are no repayment terms. You can pay that loan back whenever you feel like it. No repayment terms whatsoever. The reason why there are no repayment terms is because it's a guaranteed asset. The collateral you're borrowing against is guaranteed to go up in value every year, and there's a death benefit. So if you never pay back that loan, all that happens is the death benefit pays off the loan for you. That's it. That's it. You can also do securities based lending. So you can take out a securities backed line of credit against the assets in the market and you can borrow against it. Again, the problem is the terms are much more challenging than what you have in whole life insurance policy. First of all, there's no guarantee you can get it. With whole life insurance, the policy loan is a contractual guarantee. You can get it anytime you want. Whereas if you want to borrow against your market assets, you have to go hat in hand to a bank, to some kind of a lender, and ask for permission to borrow against your assets. And they're going to set the terms. They're going to tell you what the interest rate is. The interest rate will almost certainly be higher than what a policy loan will charge because the asset you're borrowing against is riskier. It's not guaranteed. They're not going to let you go 100% loan to value. They're not going to let you borrow against 100% of your assets. Maybe they'll let you go 50%. And the repayment terms are fairly stringent. You've got to make repayments. And if you don't, they can do margin calls. They can liquidate you. And if you read the fine print, they pretty much say we can liquidate your assets at any time for any reason when we feel like it. And this happens to people. This happens to people who are borrowing against it responsibly and making those payments. Then something happens in the market, the bank gets nervous and they just liquidate. And now they sell all your assets at a loss. So it's very risky to borrow against market assets. Now, if you really know what you're doing, that might be a good thing to do, but just understand there's a lot of risk involved there. Whereas borrowing against a whole life insurance policy is contractually guaranteed. There's no bank involved and there are no repayment terms. Pay it back if, when, and how you please. So again, these market based assets are terrible relative to whole life insurance because they're not a great financing vehicle. Whereas whole life insurance is a terrific financing vehicle. You can use those policy loans to finance investments, to finance large purchases. So instead of going to a bank to finance a purchase, you can go to your own private bank, your whole life insurance policy, and take out a loan there. Meanwhile, your full balance keeps earning for you. Mutual funds are also terrible relative to whole life insurance because they don't have waiver of premium. There's no disability waiver of premium. If I'm contributing, let's say, $10,000 a year to my retirement plan, to my investment plan, and then something happens to me, I become disabled and unable to work. Now, where am I going to get that $10,000 from? Right now, my plan is interrupted. Whereas, if I'm paying $10,000 a year in premium to my whole life insurance policy and I become disabled, I can have disability waiver premium on my policy where now my policy continues in growth even though I'm not contributing anymore. So I stop contributing my $10,000, but the insurance company pays my premiums for me while I'm disabled and unable to work. So my plan is totally uninterrupted, totally uninterrupted. Mutual funds are also terrible because they do not avoid probate. So they're terrible when it comes to estate planning. So if you have money in some market based asset and you die, those market based assets are going to go to your heirs if you named a beneficiary, or if you didn't name a beneficiary, it'll go to next of kin, but it has to go through a probate process. which means it goes through the courts. There's a 6-month minimum on the courts. Typically, the average is 12 months, and the average fee is somewhere between 3 and 10% of the value of your estate when you die. So there's costs involved too. If you have money in a retirement account or in mutual funds, they don't avoid probate unless you take other steps, unless maybe you've done proper estate planning and moved them into a trust. Whereas life insurance always avoids probate. It's very simple. You have a death benefit, that death benefit pays out to the beneficiary, no probate involved. So again, mutual funds terrible for estate planning, terrible relative to whole life insurance. Mutual funds are terrible because they haven't paid dividends every single year for over 100 years straight. Find me a stock or a bond or a mutual fund or an index fund, anything that has paid dividends every single year for over 100 years straight. I don't know of one, but that is exactly what these mutually held life insurance companies that I work with have done. So, as an example, Penn Mutual has paid dividends every single year to policyholders since 1848. That's over 170 years. And every single one of the carriers that I work with has paid dividends every single year straight for over 100 years to its policyholders. That's because their business model is based on actuarial math, actuarial science. It's not based on gambling in the market. It's based on things that can actually be calculated to a pretty high degree of exactitude. Hence why they can continue paying dividends like clockwork no matter what's happening in the market. Because while the market is very difficult to predict, mortality is actually very straightforward to predict and they're good at it. This is what these life insurance companies do for a living. They're excellent at paying out, at calculating mortality. Mutual funds are also terrible relative to life insurance because they don't have non-forfeiture options. They don't have non-forfeiture options. So what's a non-forfeiture option? Well, a non-forfeiture option is a list of contractually guaranteed rights you have in life insurance if you decide you want to quit and go home, right? If you decide I don't want to do this anymore. So, if you have money tied up in retirement accounts or mutual funds, getting your money out can come with a lot of drawbacks. First of all, if getting your money out means selling, you might be selling at a loss. Now you just have to eat the loss. If you're selling at a gain, you might have to pay taxes on the gain. If the money's in a retirement account, you might have to pay penalties if you're withdrawing it prematurely, right? So if you want to quit and go home, there could be serious consequences. There could be serious consequences. Whereas in whole life insurance, you have a whole set of non forfeiture options. I'm not going to go through all of them, but one of them would be what they call a reduced paid up. So if I've been contributing $10,000 a year to my whole life insurance policy and I decide I don't want to pay that $10,000 a year anymore, what happens is I don't have to terminate the policy. I can just tell the insurance company I would like to take a reduced paid up. And they say, okay. Then what happens is there's a one time reduction in my death benefit, but no reduction in my cash value. And now the policy is fully paid up and no future premiums are due. And then my cash value and my death benefit both start going up again because I'm still being paid interest and dividends on that policy. And there are other non forfeiture options as well. That's just one. So if I decide to quit and go home, I have contractually guaranteed options I can take where I can, as an example, keep the policy in force and still maintain all those benefits without surrendering the policy. And these are just some of the ways in which I would say mutual funds are terrible relative to whole life insurance, retirement accounts, all those are terrible relative to whole life insurance. Now, these are real drawbacks. Let me be clear. I'm only being half facetious. I'm only half joking. All the things I just talked about are drawbacks to mutual funds, if we're being fair. It is true that a mutual fund, a drawback is that it has no death benefit. That is a drawback. It has no long term care protection. That is a drawback. It has no policy loan feature. That's a drawback. It's not guaranteed to go up in value. All these are drawbacks. Just like if we say the cash value in a life insurance policy is not going to grow at a super high rate, it's not going to grow at 15, 20%. In fairness, that is a drawback. But to criticize whole life insurance for that is not fair because that's not what it's designed for. That's not what it's designed for. Once you understand what it's designed for and how to use it properly and how to fit it within your overall financial picture, you understand it's a phenomenal tool, not just because of what you get with a whole life insurance policy itself, but more importantly, how it makes everything else about your financial picture better. And that's the part that it's really hard for people to see, how having a whole life insurance policy in force makes everything else about your financial life better. So, It wouldn't necessarily be fair to criticize mutual funds because they don't have a death benefit, but that is still a drawback to them relative to whole life insurance. But you would say, yeah, okay, but mutual funds are an investment. They're not intended to be life insurance. I agree. So then let's also be fair when we're trying to evaluate whole life insurance. Understand it's its own asset class, which is what makes it difficult to judge. It's not an investment. And so all of the drawbacks I just listed to mutual funds are fair, but we're probably not classifying mutual funds properly. Whole life insurance is a great form of life insurance. It is a great savings vehicle. It is a great financing vehicle. It's all of those things. Mutual funds are not a great form of life insurance. They're not long term care protection. They're not a great financing tool. They don't have the guarantees of whole life insurance. It's not to say either is good or bad. And it's not an either or scenario. You can do both. I have plenty of clients who do both. They have whole life insurance policies, they also have term life insurance policies, and they have money in the market. You just have to understand what financial goal you're trying to accomplish and find the best set of tools to accomplish it. And oftentimes that means over the long run, you're going to do both. You're going to have convertible term life insurance, you're going to have whole life insurance, and you're going to have investments. All of them are fine once we understand what they're designed for, how they fit into your financial picture, how they fit with your human psychology, and what they're doing for you. So I think whole life insurance is phenomenal once we classify it properly. The challenge, of course, is that whole life insurance is really its own asset class. So there's really not anything out there you can compare it to. And so much of what makes whole life insurance great is how it impacts the rest of your financial life. As an example, one of the benefits to having whole life insurance, let's just go back to buy term and invest the difference. Let's say you want to buy cheap term life insurance and invest the difference in mutual funds. Okay. I would say go ahead and do that. Buy convertible term with a good mutually held life insurance company and then go and invest the difference. Okay. After you've done that, then my question back to you is where are you storing your cash? I assume you believe you need to have some emergency savings, some amount of cash on hand. How much should that be? Some people might say 6 months of living expenses. Whatever the number is for you is immaterial. How much money are you going to keep in cash in a savings account? Let's say the number is $20,000. I'm just making that up. Now let's take that $20,000 and move it from a savings account to cash value life insurance because the best place to store cash is in cash value life insurance. Now we're getting a competitive rate of return, let's say 4%, like a savings account, except that 4% is tax free. Plus, we can borrow against it without interrupting the earnings in the policy. Plus, it gives us death benefit. So now we can save some money on term life insurance because the amount of term we're going to be paying for will be less because some of that death benefit is coming from our whole life insurance policy. And there's so many other benefits it gives you as well. So even if you have no interest in the infinite banking concept whatsoever, and you buy into the whole buy term and invest the difference, I'm going to buy inexpensive term life insurance and I'm going to invest my money because I'm going to get a higher projected hypothetical rate of return, which may or may not materialize. Okay. Then my question back to you is where are you storing your cash? Where are you storing your cash? Because the best place to store cash is in cash value life insurance. So I don't have to argue with any of the logic here. We just have to follow that logic to its conclusion. Because as long as you understand whole life insurance is not competing with those investments, then you understand why it makes sense, even if you are doing a lot of investing. Warren Buffett, one of the arguably the best investor of all time, he keeps a lot of cash. Good savvy investors keep a lot of cash on hand so that they can take advantage of opportunities, downturns in the market. Staying liquid is very important. So again, mutual funds have a lot of drawbacks relative to whole life insurance. The problem is because people are myopically focused on this magical return on investment metric as if that's the only thing that matters, and they don't understand how to classify whole life insurance and what we're using it for, that's where they lose it. And again, the return on investment in the market is totally hypothetical. Stop behaving as if it's dogma that you will get 8 to 12% returns in the market. Well, maybe you will. The Dalbar report tells us actually people are getting 3% because you're not accounting for human psychology and so many other things. Yeah, in theory you could get 8 to 12%. In theory you could get 100%. But that's all theoretical. That's all hypothetical. Whereas whole life insurance, the returns we're getting here are guaranteed. I hope you enjoyed this little conversation about why mutual funds are a terrible form of life insurance, why they're terrible financing tools, why they're terrible long-term care protection, etc. But whole life insurance does a great job at all of those things. And if you're going to do the infinite banking concept, what you'll be doing is running your cash flow through your whole life insurance policy and then using policy loans to finance everything else you're doing. So if you want to buy those mutual funds, great. Take the money you've earmarked for mutual funds, pay them as a premium in your whole life insurance policy first. Now you've permanently captured those dollars inside your personal economy where they can never escape and where they will keep earning for you from now until the day you die. Now take out a policy loan and go and buy those mutual funds. Now you're earning in those mutual funds and you're earning as the bank that financed the purchase of those mutual funds because your whole life insurance policy, that cash is still earning for you inside your policy. So you can use whole life insurance for a lot of different reasons. You can just use it as a savings account. That's fine. Just store cash there. That's not the infinite banking concept necessarily, but that's still a great use of whole life insurance. And I can design it for you in a way that I think a lot of the opponents of whole life insurance are not aware you can even design it this way, where you get so much more cash. I think most people don't even know that's an option. They think that the cash value growth in the early years is non existent. Well, not the way I design a policy. And if you want to learn more about how policies can be designed for this, please come and talk to me. But I hope you enjoyed this. This has been Logan Hertz with Hazeltine LLC. God bless. Godspeed.